All right, good morning. Today is December 21st, 2022, and it's officially the first day of winter, and it's just a few days before Christmas. So I thought I'd come on and do a quick show this morning. Not a whole lot to talk about that we haven't already covered this year. So the market itself this time of year is typically, well, that's typically just weird, right? I mean, holiday trading, a lot of people are, I would say institutions are off their desks and the volume's a little bit low and just not a whole lot going on. Most people are focused on other things besides the market, and especially this year. This year's been kind of a big letdown in the market, I think, for a lot of people. I remember back at this time last year, all the big Wall Street firms, they're coming out with their predictions for the following year, and the S&P was, well, let's see, this time last year I just happened to have a 1 year chart up, and so here we go. This time last year, um, we were like, hang on a sec, let me see where this is. Right, December 20th, that was yesterday, and December 21st. Interestingly enough, let me zoom back here a little bit. Last year, like, it looks like the 17th, the and the 20th, so that would have been Thursday, Friday, and that Monday we had like a little few days down, and then a little bit of a rally here. You can't call it the Santa Claus rally because the Santa Claus rally, which most people just throw out there vaguely, but I'm sure by now you guys know that the Santa Claus rally is the week in between Christmas and New Year's, and then like 2 days into New Year or something like that. So this year, with Christmas and New Year's falling on Sundays, the market is closed the following Monday so that everybody gets a paid holiday for the holidays. Anyway, last year at this time, here we are. December 21st. I don't know if you can how well you can see that on the chart, but let me get the little crosshairs off. So right there, we had a little dip and then a little sort of rally into Christmas and the end of the year. And then that little consolidation there, like right at the end and the beginning of the year, little itty bitty tight range, that was the all time high in the history of the world. And then it's been all downhill from there, I should say. So, stock charts, those of you that use stock charts, I'm sure received some emails about some upgrades that they made. And I've noticed a few things are a little bit different, but here's something super cool that they did is they gave us the ability to undock or to dock and undock the drawing tools, right? So now I can actually without skewing my chart, I can draw a trend line. So this is fantastic. All year I've been complaining about how it's just kind of weird doing a live show here because I have a certain screen on my computer that's being recorded, like an area on my screen. And so before they did this docking and undocking thing, in order to draw a trend line, it would skew the chart. So anyway, this is a big improvement. I'm just now finding out about it and learning about it. So they've got some other kind of cool things that I've noticed. So big upgrade on stock charts. Anyway, I mean, we've been looking at this particular trend line pretty much all year. Obviously, we couldn't draw this trend line until after this little high right here, right? Initially, at the beginning of the year, when the market kind of peaked out or whatever, you'd see this was the trend line here. We got the big sort of sell-off at the beginning of the year. There's a few years that I can recall that the market sold off like right at the beginning of the year. See, the standard script on Wall Street is this. Um, in late December every year, all of the talking heads and analysts and pundits and the people that appear in the Barron's Roundtable. Now, I mean, this year may be different, but 9 out of 10 years they all come out and they say Well, we expect the market to be up 8 to 10% next year, right? I mean, that's been the standard for, out of the last 20 years, probably, 17 or 18 of them, that's a standard talking point. We expect the market to be up 8 to 10% next year, right? So, anyway, this past year, um, the Wall Street targets were really high at the beginning of the year because the S&P was trading around 4800, 47 4800, and so everybody's targets was up around over, well, several of them over 5000, right? 5100, this and that. Anyway, I think I saved an article somewhere that says Goldman Sachs or something expected like two, 2 to 4 rate hikes. I forget exactly what the number is, but anyway, long story short, I don't think at the end of last year, going into 2022, nobody really expected inflation to get out of control and the Fed to embark on the type of interest rate hiking cycle that they did. And then, of course, the Russian invasion of Ukraine happened here right after the beginning of the year, and I can recall when they were amassing troops on the border, there was a lot of talk about, well, this is just an exercise. They're not actually going to invade, this and that. So, I mean, a lot happened quick at the beginning of last year and sent the market kind of for a tailspin, right? Like right out of the gate. I think it was 2011, as I recall. I'm pretty sure it was 2011 that the market dropped like 11% right out of the gate in January and just totally took everybody by surprise. And so, hey, you never know. Um, and based on the idea that we've kind of had a bear market, interestingly enough, as of yesterday's close, the S&P was down about 18%, right? So the bear market line is, a couple of percent lower. We're getting a little rally today because actually we're up 1%. So I guess that would mean that maybe, the S&P right now is only down 17% on the year. But what's crazy is the difference between the different indexes, right? Because the NASDAQ 100, the old QQQ here, is down, about 30%, right? I'm looking at like I guess data as of yesterday or something. But anyway, it's just as easy to say 30% as 31.16. But yeah, I mean down 30% on the Qs. That's seriously, that tells you that it is indeed a bear market, right? Um, and the funny thing is, you could always come out and say, hey, well, the Dow is only down 8%. And so, is the Dow in a bear market? Geez, I don't know. Um, I mean, it was. It took, I believe at one point it was down 20% roughly. I'm not even positive about that. I'm not going to fool with my chart, but the crazy thing about it is that the Dow has had like this huge rebound here, which I can only attribute to people going into defensive stocks and away from tech and all that. But for the Nasdaq to be down 30% and the Dow to only be down 8%, and quite frankly, I mean you can see it's up 1% here, and last week, back here at the highs, geez, it was probably only down, 6% or whatever. So this rebound in the Dow is actually pretty amazing. So, but of course, the Dow is a price weighted index and not really representative of the market. I don't talk about the Russell a whole lot, even though, and the reason for that is right now is that in a bear market, the last place that you want to be is small caps, right? Um, I mean, pretty much so. Obviously, there's individual, small caps that have probably done great in that, but in a rough environment, um, investors and institutions and the money gravitates towards the larger cap, kind of stable stocks like Coke and Pepsi and General Mills and these type of things. And obviously, it's been a tech wreck this year with the Qs, and all the big cap tech stocks are struggling a little bit. Apple is down, significantly. The interesting thing about Apple here, and notice on the chart, let me make sure I got everything lined up right. Yeah. Notice on the chart here, well, basically what we're doing here is just kind of reviewing year to date. This is pretty amazing because, well, just because Apple is, as of yesterday anyway, was probing like the lows of the whole year, which is a little bit uncharacteristic and odd because of, but this Apple is kind of traded differently than the indexes, right? And especially this particular rally here from mid-June until say mid-August, that rally was unlike most charts that you see out there. I mean, it was, basically came within spitting distance of the high. And then the fact that it's lost all that and traded back towards the lows, just very unusual. So, the big Apple, Microsoft, yeah, it's down fairly significantly from the beginning of the year. Like I said, I can change these charts but I'm not going to fool with it. I'm not going to fool with changing the charts to show like the percent. Because the one thing, and I'll have to look at this, the one thing that I'm still a little, I don't like about the free stock charts, or anyways, is is the scale over here. Like this scale, I would prefer to have a setting where I could make it more or less dense. And what I've noticed is that the density of the numbers, it's just kind of difficult sometimes to figure out exactly like what's going on, because the scale is not dense enough. That would be a nice setting, and who knows? I mean, maybe they've added that and I just haven't found it yet. So I need to do some exploring because they just had their big upgrade. Anyway, you can see Microsoft down fairly significantly. Tesla at one point was, and this is a whole nother story, but um, interestingly enough, at the beginning of the year, Tesla was $400, and down here is where it was lost half its value, and now look where it is, $140. So that's pretty rough. And of course, Facebook, absolute disaster. So, half of the market, roughly, half of the market has almost been like the dot-com bubble imploding, right? I mean, when you got, anytime you have like these mega cap stocks, Facebook, which they call Meta now, from 350 to, to $100. And of course, you guys know I like to use ARK as my proxy for high growth, high momentum, what I call highly speculative growth stocks that supposedly have, innovative type of things. Cathie Wood, she's something. She obviously, well, I mean, here's the thing about ARK. Let's look at a longer term chart. What's crazy what's crazy about this chart, monthly chart of ARK, is, and I mean, hey, look at this, it started off back here, and this little run here from 2020 up. And I look at a lot of these tech stocks and I think to myself, well, they just went parabolic and got, obviously overvalued. And, it's tough to put a valuation on a lot of stocks that constantly lose money, have never had a profit in a quarter, but are innovative, right? And so that's her whole thing. But this is what a lot of stocks looked like, after the dot-com implosion of 2000, the year 2000. So from 1995 to 2000, they had these parabolic run-ups, and it was a new paradigm, and this technology was going to change the world, and it did, quite frankly. There was some legitimacy. Actually, there was a lot of legitimacy to, the dot-com bubble. It just got out of control, right? Because back then is when all these companies were getting on the internet and building websites and building, that's when airlines started saying, hey, we could use the internet to let people make their own reservations, right? And every other company was like, hey, we could use the internet to let people order stuff, from their living rooms from us, and this and that. So, Amazon was just getting started as a bookstore and all that. So all the companies, were going online and getting networked, and Cisco was selling routers, and Microsoft, came out with Windows and all this. So anyway, the whole the dot-com era, which was, 25 years ago, I guess, roughly. And I believe it started in 95, and of course, that's when chips and well, I mean, here you go. Here's a perfect example. I like to look at Intel, because you go back to there you go. The interesting thing about a lot of the charts is that they, there's a similarity to them, right? A parabolic run up, and then basically, a crash back down to sort of where it started. Obviously not where it started on Intel, but yeah, it's pretty amazing chart. And then, look at how Intel spent all this time, what, about 12, 14 years or whatever, just sort of bouncing in this channel here, not really going anywhere. And then, of course, then we had another bubble, right? And look at it now. Um, yeah, pretty amazing stuff. But anyway, so, there's the dot-com bubble back there. Monthly charts are fun to look at. Um, as I recall, GE was, and I'm not sure why, GE was such a beneficiary of the dot-com bubble in general, but it's crazy to look at this, monthly chart of GE. I mean, that was like the number one blue chip company in existence back then, and you can see this parabolic run up, right? And so, just like I said, 1995, when Windows 95 came out, man, that changed everything, right? Because people were no longer having to use DOS and all this and that. And that's when everyone started getting on the internet, like shortly after Windows 95 came out. That really changed the world. Win 95. That was my first home computer. Well, I shouldn't say that. It wasn't actually my first. It was my first real computer, right? Windows 95. That was the first computer I used to get online. And of course, once I got online, I realized that, hey, this kind of changes everything, and it did. So this was all about a build out of the internet and technology and all that. And then, of course, in typical fashion, Wall Street went crazy, and all of a sudden, you had all these companies going public that, their whole business model was getting people to click on banner ads and stuff, and and so it just got out of control, got too speculative, turned into a bubble. We all know the story of that. So back to the old S&P here. Back to the old S&P. Yeah, interesting looking chart. Interestingly enough, this monthly chart, geez, you could almost draw a parallel line and say this is a big, gigantic bull flag, right? I mean, the monthly chart kind of looks like a big bull flag. But anyway, hey, who knows? back to reality here. Not a lot of time left in the year. Let me zoom back out to the whole year here. So, you get this little sort of this recent sort of spike down. Oh, the other thing I was going to mention, that little probe above this trend line. I mean, a clear probe above the trend line, and that 4100 there, which is like, the high this day was 4100 and change, and the high this day was 4100 and change, right? So, I mean, right there, 4100 is, and not that we're going to get there, anytime real soon, but that's really the biggest level right now. For most of the year, 3900 was one of the biggest levels on the chart. Let's see, let me put it. Yeah, every time I zoom, 3900 was kind of the main over and under, and it still is, to some degree. I would say 4,000 is probably the most important over under right now. Let me get this off of here. The reason being is that, at some point out here, if we extend this trend line out, you can see, and of course, the trend line would look a little bit different depending on. Here's something I like to do with my trend lines. I should make a trend line like that, right? That's that's a viable trend line right there, because at least this way, you're not going to haggle over a couple of pixels or, 10 or 20 points in either direction. Now that little spike up, intraday spike up, that was a clear break of the trend line. I think a lot of people got excited, but so early in the year here, in January, um, that trend line is going to intersect with 4,000, which is going to be kind of interesting. So it's going to be very interesting, actually, because eventually, if the market can break over this trend line, and maybe it breaks over it and then kind of, vacillates around it, or breaks over it and then comes down and touches it from the top. Um, See, here's the thing about technical analysis. People love to shun technical analysis, but I'll tell you this. It's almost like a joke, right? So we had, all these touches of the trend line, but this last one here, this big sell down and sort of this capitulation reversal bar, at 3,500, the odds that it would rally up right smack to the trend line, and the 200-day moving average, which I don't have on the chart right now, is like right up here too. And like, so you guys remember back here, like the 200-day moving average and the trend line literally intersected right at the high there, but the odds that it was going to rally all the way back up to that trend line and get turned back were just seemed astronomical, because it was almost too easy. Like literally everybody that, had been looking at any chart anywhere of the S&P knew that this downward sloping trend line was right there, and so, they would think, well, it's either not going to go up and hit it, or it's going to hit it and break or whatever. But I mean, the idea of it getting rejected right smack at the trend line, and then of course this was a little anomaly. This had to do with this was when the CPI number came out, right? So the CPI number came out, and everybody's like, oh great, it's only 7.1%, because it was lower than expected, and so that was kind of, they really jammed people there, because then the next day Powell came out, and I've heard Powell say that 5% inflation is not acceptable, and so the market gets all giddy and thinks the Fed's going to pivot and this and that, and that's been going on all year. Well, not all year, but most of the year, at least the second half here, is the market thinks that the Fed's going to cave in and quit raising interest rates, and then, the economy's going to suck, and so they're going to lower interest rates. And, how many times have you heard somebody talk about a Fed pivot? So, and to me, I mean, there's you got to pause, right? They haven't even paused yet. First, you got to pause and quit raising interest rates, and then and then they keep saying over and over they're going to hold interest rates for, all of next year. They're going to keep interest rates high because this is basically all they can do to tame the inflation monster. And they need to see a bunch of CPI prints that are coming down and down and down. And it's still a long way to 2% inflation, right? Now, if the economy goes into recession, and that's the other thing too, is, this whole little sell down, this past week or so, you would see on CNBC, it's like, markets selling off on fears of recession, right? And then today, and then it sells off real big, and today we get a headline that says, the market's rallying because of earnings from Nike and FedEx. So they literally have to come up with the reason every single day why the market is moving in one direction or the other. But anyway, it'll be interesting. I mean, there's not a whole lot of trading days left in the year. There's 2, 3, 4, 5. There's like 6 trading days the rest of the year, because the market's going to be closed next Monday, so that means next week's 4 days, and then you got today and 2 more days this week. So, and here's the other thing: I wouldn't put anything into what happens this time of year. Everybody's getting ready for Christmas, and fortunately, I'm ready for Christmas, and the weather outside's nasty, and so if it wasn't, I might be out doing something else. But and by the way, the whole country is bracing for hideous weather over Christmas weekend. It's going to be insane. It's going to be the coldest Christmas in ages, right? And we're going to get a hard freeze here, which I don't think we got a hard freeze last year. So I haven't turned my heat on yet this year. And it's actually been very pleasant so far, so I'm not looking forward to it. But anyway, back to the market. So, yeah, market's going to end the year down somewhere, 15 to 20%. Probably closer to where it is now, 18%. Who knows? I mean, next week, just like last year, and you get these sell downs, and then you get the rally, and then you get the sell down and the little rally, and so we've had the sell down here, and so it's due for a bounce. I'd be kind of surprised. Be kind of surprised if it can bounce all the way to 4,000. So with 3,900, like I mentioned earlier, and I've mentioned a gazillion times on the show this year, recently, past since the summer. 3,900 has been sort of the over-under, so chances are, we close at 3,900 and change, or 3,800 and change, probably somewhere in the neighborhood of right where we are now. What would be interesting is to close like right around 3,900, but 4,000 is going to be the big over and under for the new year. Over 4,000, hey, things are looking up. Under 4,000, and watch out. We did look at the Russell, right? The Russell, as I recall, actually let me pull it up over here. Russell 2000 down right around 20% year to date. So there you go. And it started off on kind of a high tick up here, like up at the highs. I'm sorry. No, it wasn't at the highs. Yeah, the interesting thing, you guys remember last year, I had the box drawn around this price action. It was just up and down and up and down. It just went nowhere, right? And I had that big rectangular box drawn around the Russell. And then it broke out to the upside, which was a huge fake out. I mean, that was just a massive sort of fake out for everything, because it broke out of that box, like, you can see where it broke out of the top of the box, and it was very short-lived, came right back into it, and then obviously it's all been downhill. So I mean, with the Russell being down 30% year to date, or I'm sorry, 20% year to date, it's significantly off the high. Interestingly enough, it was the first index to peak, right? I think. Yeah, well, the NASDAQ kind of did that too. In late 2021, it had this huge run and kind of peaked up there. And so it's not just year to date. I wondered what that was. It's not just year to date. It was started back in 2021 up there. And what coincides with that is ARK, right? I mean, and when I look at a lot of these charts of, these stocks that went parabolic and then came back down, it was basically the post, well, I guess it was the pandemic, not post-pandemic. It was the whole thing where everything sold off. The market sold off about 30% when the pandemic hit, and then when the Fed went crazy and lowered interest rates to zero and threw trillions of dollars in the market, that started the parabolic run-up of everything. And then, the rest is history. So everything it had, parabolic run-ups, and here's a good example. This is Zoom. Now, this is probably one of the best examples of the whole, what I'm talking about here. The parabolic run up during and after the pandemic started. And then of course, what happens when you get a parabolic run up? Well, eventually you get the other side of it. So it's like a mountain range, there's the summit right there. And here we are on the other side of it. So perfect. This is probably, besides ARK is actually the one that I use. But this is a great example because this is one of their favorite stocks too, right? And I mean, hey, it's video conferencing. There's some other company, there's a whole bunch of other ones that do the same thing, and then there's a newer one that people say is better than Zoom. So, but to Zoom became like a verb. Right? Let's Zoom later. Meaning, a video meeting with multiple people. Big deal. We were doing video calls 20 years ago. They just, obviously there's more features and cool things about it and different things, but I mean, it's the same thing. It's like I have this I have Pandora and I have Spotify on my phone, these streaming apps, and it's like they reinvented radio. I mean, it's basically it. Yeah, now of course you can pick the songs that you want to hear, or this and that, but I mean, when the rubber meets the road, I mean, it's funny, all this new paradigm stuff. But anyway, there's a good example of, a new paradigm. The end result of it is it's not really a new paradigm. It's just, anyway, so just like the dot-com bubble. So the crazy thing is, I'm going to wrap this up because there's not a whole lot to say. And I can't tell you what the market's going to do in 2023. I don't know. But I do know this. Right now, the trend is down. The market's in a downtrend and has been for a whole year, right? And so as far as trading opportunities, there's very few opportunities to get long this market and make money, right? There was one back here in March, and basically, the market's looking terrible, and then at some point, you get a relief rally, and 2 days into that relief rally, you're thinking, hey, okay, well, maybe. See, here's the thing about trading these rallies in a bear market. That would have been like your first inkling that, okay, well, maybe this thing's going to go back up or whatever. And so, if you spent the next couple of days like positioning yourself, with some stocks, well, you had a little bit of a hurrah there, and then boom, all back downhill, right? I wouldn't call this a tradable rally right here at all. As a matter of fact, you remember when we were watching this little consolidation, and the consensus was we were going to break out up out of this and trade back up to 42 something. But anyway, same with over here. There was another tradable rally, theoretically, in mid-July here, but this really quick sell-off here, and this was something about Fed hawkishness or something, I forget, but you can see the market just fell out in 3 days, man. Boom, that was wild, actually. In order to participate in this rally, unless you're trying to pick bottoms, which is typically usually not a good idea. You would have wanted to wait until some of this resistance got cleared. And so, there was one more tradable rally. And then so, same over here. Same over here. That was basically, this sort of area here. It gave you a little bit of a tradable rally. But here's the thing about it is like trying to time those or just look at the chart and decide, hey, I want to go ahead and buy a bunch of stocks in a bear market, for trying to pick the lows. That's the other thing. All year long. All year long. I mean, since here, right? Like since right there, all these guys they come on TV and they say, well, we think the lows are in. Right. They start calling for, we think the lows are in here. The market, this and that. And so they call a low there. And then of course that was obviously, a capitulation low there. So, but the thing of it is the market's got to like move off of those lows fairly substantially until before you can say that we might have seen the low. And so just over and over, they've tried to call the lows all year long, and so pretty funny. And especially this one right here. I mean, everyone was like, well, here's the thing is like on that low, they waited and you had to wait until like over here somewhere, and then they started calling the low right there, right? And so every move off the lows, everybody, not everybody, but a lot of people think the lows are in and they're not. And then of course, now we got this low here at 3,500. And, and I had drawn some fibs on the chart too. And there was a lot, of technical analysis was amazing this year, right? Like this 3,500 was like a perfect, was a 61.8%, fib retracement from, this run up or whatever. It's pretty amazing, honestly. And then the whole idea that each time the market rallied up to this trend line, I mean, it's almost too perfect, right? And then we talked about this last week, sort of the symmetry between this, sell off and bounce to the trend line, and this one just on a bigger scale with the white space in there. So pretty interesting stuff, really. The market doesn't really follow the calendar so much, so it probably just vacillates either over or under 3,900, over the next 6 days. Yeah, I suppose seasonally speaking, it's a strong time of year. So theoretically, you could get a little rally up towards 4,000. That'd make everybody feel good. But I'd be shocked to see it above this trend line to end the year. And even the trend line is above 4,000 right now. So that's not real likely to happen. Best case scenario is a rally up just shy of 4,000, I would say. So who knows? And like I said, the next few days don't really mean anything. So anyway, I thought I'd come on and do a little show today and wish everybody a Merry Christmas and Happy Holidays and all that good stuff and Happy New Year. I might come on and do one next week just for the fun of it. See where we are and update it. But not a whole lot to say here. It's been a rough year, and it's hard to know. The thing about all those interest rate hikes is they still haven't necessarily filtered their way through the system, right? There's like a lag there, so it's gonna be an interesting year to say the least, 2023. Anyhow, I hope you guys have a great Christmas and Hanukkah and holidays and all that good stuff, and it's a good time to be doing things other than worrying about the market. So, with that said, I will most likely see you here next Wednesday, same time, same place. Thanks for tuning in.